Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And in case you don't know, my name is Goose, and I'm going to be talking today with a guy called Lloyd Edge. Now, interestingly, for all those of you who don't know, me and my partner Gabby run a buyer's agency service called Dash Dot. What we focus on is helping people to master the holy trinity, which is cash flow positive properties in high growth areas with value add potential. And that allows people to build a scalable property portfolio and to achieve their property goals and their freedom goals up to 6 times faster than traditional investing methods. This is the first time that I have had a different buyer's agent on the show to talk about this kind of stuff. Now, the reason that I did this is because Lloyd is super aligned with the way that we do business as well. He's written a book called Positively Geared. It's called Positively Geared, and it talks about how to build, how to start with a pretty from early beginnings and to build that kind of a portfolio. And we talk about all of this kind of stuff on the show. We talk about the importance of positive cash flow, the different ways to add value, why it's important to focus on not just positive cash flow, but also thinking about how to deleverage your portfolio to continue moving forward. And really, we talked about all of the things that you need to know to be able to really build a scalable property portfolio. So there are a few things that we maybe don't necessarily see eye to eye on in this episode, but that's okay. That's okay, because what we do agree on is the principles of the fact that no two people are the same, no two properties are the same, no two strategies are the same. And the most important thing is to operate from a set of principles, make sure you've got the right characteristics that we call the Holy Trinity, and to make sure your portfolio has a good, healthy mix of different types of properties that are going to serve you to reach your end goals. So if you're interested in learning about that kind of stuff and hearing that kind of story, I think it's really valuable. And if you're interested in wanting to accelerate your own property journey, and if you want to build a scalable property portfolio, and if you want to achieve your goals 6 times faster, then I encourage you to reach out to us directly. So you can go to theinvestorlab.com.au. This is where you can find more episodes of the podcast. If you're listening to that and you want to check that out, you can also reach out to us there. Alternatively, you can just book in a call with us direct. So just head to dashdot.com.au/discovery. You book in a 15-minute call with me or the team. We'll talk to you about your strategy. We'll talk about where you're stuck. We'll give you some guidance on what the best next steps would be, and we'll help you to master the game of property investing. But without any further ado, let's get stuck into it. I know that you're going to get a lot out of this episode. I really enjoyed it. I don't really have the opportunity to chat with other buyers agents very often and really talk to other, we operate a little independently. And so really talking to somebody else who's in the space and who's doing good stuff is really valuable. And I think his insights are going to be valuable to you too. So without any further ado, let's get stuck into it. I look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is a guy named Lloyd Edge. Now, he is a fellow buyer's agent, but more importantly, and what I think is most fascinating, is that he is living proof of building a scalable property portfolio. He's the author of a book called Positively Geared, which is great. And that tells people and teaches people how to go from a very low starting point to actually being able to build a scalable property portfolio. He's done it. He's got a portfolio of about 16 properties. And I'm really interested in having this discussion because whilst we are in the same industry and in the same business and ostensibly competitors, I think we've got a really strong alignment in the way that we go about doing business, in the way that we care deeply about, how the why around what people are doing and why they're doing it, and actually how to make that a reality. So, Lloyd, welcome to the show.
Good morning. How you going? Really good to be with you,
mate. It's awesome. So, look, I know a little bit about you and who you are and all of that kind of stuff. But for the benefit of the people who don't know who you are and what you've done and all that kind of stuff, do you want to give us a quick high-level summary? Tell us a bit about yourself.
Yeah, well, basically, I haven't always been in property. I've got a background as a teacher. Yep. So for many years, I was a teacher, but on the side, building a property portfolio because I felt that the income from a teacher wouldn't allow me to, live the life that I wanted to, or even, be financially comfortable when I got towards retirement. As I was going along, I sort of discovered lots of different strategies on how to actually move forward after making a few mistakes when I was first starting out. And one thing led to another. My passive income from my property portfolio overtook what I was earning as a salary. So that allowed me to essentially retire from teaching. And then I basically went in and started my business. I was property professionals as a buyer's agent, essentially to help others to try to achieve their dreams, essentially.
Yeah, that's awesome. Because that's interesting. My background is not, well, not maybe not that obviously. My background is not in real estate either. I was in a completely different industry and started the business for the same reason. We actually went and made a mistake and then went, hang on a second, how do we try and not stuff this up again for ourselves, and started building out our own. And really, we were looking internally and going, well, how do we try and live a better life? It was all about us, right? To be honest, at the start. And then we sort of, after a lot of time building out research methodologies and all that kind of stuff, just trying to find the answers to the questions for ourselves, we went, oh, hang on a second. Geez, a lot of other people could probably benefit from this too. So let's try and go and help people. I'm interested though, at what point, like how long did it take you to go from, all right, I've just started investing and I'm currently a school teacher. How long did it take you to go from that point to, geez, I don't need to work as a teacher anymore?
So all up, that probably was 12 or 13 years. However, it was probably about 6 or 7 years once I really set my mind to it. Now, at that point, I already had a few properties. But when I first started investing, I didn't really know what I was doing. I was buying properties, most of them in Sydney. They're negatively geared. And sure, they've kind of done well over the years. But when I first started investing, I was in a lot of debt. I didn't have much cash flow. And I was thinking there must be a better way of doing this. A few years after that, I did sort of make a decision that I wanted to be able to retire from teaching. And when I started to really think about why I wanted to do it and how I was going to be able to do it, and that there was better ways than just buying a property and holding it, then I had a much more clear time frame, which is probably about 6 years from there to get to the destination of retiring as a teacher.
Yeah, that's awesome. What do you think is you obviously started out negatively geared. So did you end up selling some of those properties and getting rid of them and starting again? Or did you just focus on, all right, how do I now add better properties to my portfolio that is going to allow me to keep moving forward? And what do you think, what did you learn that was the turning point moment that you went, actually, I can achieve this and I can get to where I want to go?
Yeah, so I didn't actually sell any of those properties at the time. A couple of years later, I did, but because a lot of those were actually quite good properties, but they just weren't serving the purpose. So I would have ended up with maybe 5 properties across a number of years, and over a period of 30 years, I might have had a lot of growth with them. But what I needed to do was really turn things around. So I started to look for ways to move forward, and I thought positive cash flow was the way to do that. But however, I didn't realize at the time that you can't go from one extreme to the other. So I also made quite a funny mistake, which I talk a lot about in my book because it's quite funny. I bought a property in a mining town called Blackwater in central Queensland, which was achieving about 25 to 30% growth annually. It's a property I paid about $250,000 for, and it was renting for about $900 a week. So I thought, I'm onto a winner now. Now I know what to do. I'll be able to retire now in a couple of years. Held that property for a while, and then the mining boom collapsed. So big learning there was not to invest in one-horse towns and one industry towns. But to get back to the other part of your question, it's really about, for me, was understanding how important cash flow really was to be able to move forward in your portfolio, and then being able to add value to properties. Because when you're buying it, and when I first started investing, it was just after the Sydney 2000 Olympics. So the market had already boomed. So I was buying when the market was starting to decline, and I didn't have any idea of those sort of fundamentals at the time. So later on, when I really started to think about what I was doing, it really came down to buying properties where I could add some value, whether that was through a renovation or a duplex. And the thing that really changed my life was the first duplex I built, where I gained $140,000 in equity on completion once I did the subdivision. That was twice as much as what I was earning as a salaried teacher at the time. I was going to work every day. I was pulling in about $70,000 for working all day every day for the year, and then I got this equity from building the duplex, and I thought, hey, I'm onto something here. I need to repeat this process. And I just thought, why am I going to work every day and doing this when I could set this strategy and move towards my goals of retirement?
Totally. So that duplex, tell me about that. Did you buy an existing property and then build a second dwelling? Was it like a house and land package type duplex type thing, or how did that come about?
So no, it wasn't a house and land package or anything like that, but it was actually in the new estate, but it was the last block available in that estate. Now, I was in a country town, Armidale in northern New South Wales. And it was a corner block that was available, and the block had come back on the market because the last buyer's finance had fell over. So I ended up putting in an offer and getting it for about $30,000 cheaper than what the last buyer had gone under contract for. So that was all good. Didn't really know what I was doing, so went and found a builder, of course, and then the DA process and everything like that was quite interesting, and I had to learn a lot of things along the way and try to seek some advice from people and things like that. But and I didn't really know what I was doing. I was nervous whether I was going to actually get the results I wanted and stuff. But that's how sort of that kind of came about.
Did you, when you were starting that process, you just said you were nervous about whether you were going to get the result you wanted. How much forethought did you put into it? Like, okay, did you do feasibility studies on that, or did you just sort of go, well, I can get the land a little bit cheaper than they were trying to buy it for, and all right, well, I guess if I build a duplex, I'm going to have two incomes, so that'd be like, how much real strategy was in it, and how much was it like, take action and just kind of hope for the best, and it worked out? How much was of those?
There's probably a little bit of both. There's probably a little bit of take action, hope for the best. But I looked at the numbers. I spoke to some real estate agents around town and what the property would be worth on completion and things. Still didn't give me a lot of confidence because I didn't sort of see a lot of comparables and stuff for that. So I was kind of thinking, if I get 50 or 60K equity in here, then I've made a bit of profit that if I just bought an existing property, I'd have to be waiting for growth, and I could be waiting a couple of years to make that sort of equity. So I was underestimating what I could make. And then it ended up getting a much better result, which, obviously if it had been a bad result, then that may have just turned my circumstances. I may not have done that again. So it's quite fortunate that worked out quite well.
Yeah, awesome. So how big a role do you think, because it's interesting, so what we talk about to all of our clients and on this podcast quite a lot is what we call the Holy Trinity, and it's not dissimilar from what you're talking about there. So we talk about buying in good growth areas so that you've obviously got to be able to identify those, buying for positive cash flow so that you can keep your serviceability in the right place and keep that liquidity in your portfolio, but then also focusing on a value add component. Now, the way that I see it, there's different ways to add value or to have those extra levers in a property portfolio or in a property purchase. Under market value is one, buying below market value. And if you can get below market value and positive cash flow and in good growth area, that's one way to win. Another way to add value could be through a renovation or through a granny flat or through doing a subdivision and adding a second dwelling. This kind of, and depending on where people are at in their portfolio, I think it's appropriate at different stages. So what are your thoughts on that? And what do you think, for people that are earlier on in their property portfolio, what do you think is the most important couple of things they need to think about in order to be able to, keep growing that portfolio? Because most people want the same thing. They want freedom, right? They want to be able to go, I'm going to invest in property and I want to not have to work anymore. So if they can do that in sort of 5 to 10 years, we'll use that time frame. What do you think the most important things to focus on are?
Yeah, well, I guess to answer the first part there, you've pretty much covered everything there. I call it the property trifecta, which is obviously buying in a good growth area, having good cash flow, getting that instant equity, and you've sort of covered everything there. And that's all really important. But for someone who's just starting out, what's really important, I think, is really understanding your goals and what you're trying to achieve, and then setting a strategy there and understanding how that's going to help you to achieve that. Because different people have different goals, and some people they might have a mortgage that they want to pay off. So, for example, I've paid off a couple of principal place of residences in the past by using equity that I've created from a duplex development and things like that. So having that, or you might want to put your kids through private schools, which are expensive, or you might want to retire. You might want to go on overseas holidays. Maybe not at the moment, but when we can go overseas, we can do all that kind of stuff. So you really need to know what you're trying to achieve. A lot of people come to me and they kind of want to build cash flow. They want to replace their income, which is I guess essentially the same as retirement. So if it's 50K, 80K, 100K, then we look at how you can achieve that. What's really important, though, is firstly getting a really good asset base. So that first property still has to have all the fundamentals. So before we even look at anything else, it has to be in that good growth area. There's no point buying something that's in a bad area that's just going to have really high cash flow on it and nothing else. So you really do need to buy where the government's spending money, there's infrastructure, there's rising population, and I think where places that are driven by a hospital, university, all those things are really important, and buying with a school catchment zone. So really getting something that's a good growth property first and understanding how to find that. Then once we've found that and even pinpointed the right street or the right parcel of the suburb, then how we can add value to that property in the future. Now, if you're on a bit of a limited budget, you may not be able to add value right away. But if something can be a bit unique about that property, so it might be a slightly larger block, it's got the potential to put a granny flat on it, or it's got potential to develop in the future or subdivide, or a renovation is quite an easy sort of strategy there, because that's something you can go in and do as long as you're not overcapitalizing. But then again, you also need to understand the difference in sales prices between unrenovated property and a similar property that is renovated. So there's a lot of intelligence there. So understanding that, in terms of being able to move forward, having good rental yield is always very important, particularly if you're on sort of a lowish to middle income, because that cash flow, you need that cash flow to be able to move your portfolio forward. It's a little bit different if you're on a really high income and you don't have any problems with cash flow and you need to get a bit of money back on tax. You don't mind negatively gearing something. You might be able to buy a couple of properties in Sydney off the bat. But for most of us, like when I was a teacher, that wasn't necessarily the right way to go at the time.
Totally. I want to dig into that specific element there, the yield, right? Because obviously it's critically important to increase your cash flow and all of that kind of stuff, so you're contributing more to your total overall income pool, and that's what's going to allow you to keep moving forward. From a finance strategy perspective, though, there's differing opinions depending on who you speak to, right? There's differing opinions around how much the rent can contribute to actually keeping you moving forward. Like some people out there say, well, yeah, I mean, you can get, 9% yielding properties, but they're not actually going to do anything for you because, they'll cap the addressable income at 6%. And then they'll corrode that even further by putting some other metrics on it. And so a lot of people think that it just doesn't work, like that actually just won't keep you moving forward. But I want to know your specific opinion on that role and your experience on using that to continue that liquidity to move forward.
Yeah, so you're right. A lot of banks do cap things at 6%, and a lot of banks do sort of use a metric of only 60 to 70% of a property's rental income. But if you've got a property that's only got a 5% yield, which a lot of people might think is an okay yield, and the banks only take 70% of that, then that becomes even a lower yielding property. So you're better off getting something a bit higher. Now, if you're at a 9 or a 10% yielding property, that's likely to be a commercial property, or it might be, a cash flow property in a regional area. That's probably not the greatest property. So I tend to, at the best of times, probably have properties that are probably 6.5 to 7% yield anyway.
Yeah. That's a good target. I agree. 6.5 is kind of like a nice spot to be. Yeah.
That's what I call a good cash flow property. I'm not into these, people who talk about NDIS properties, they can get 20% returns and all that.
No.
That's not for me. I'm not.
No, because it's too tied up with schemes, and it's does it stand on its own 2 feet or not? Like you can never really kind of work it out, and it's I've
never spoken to anyone who's actually got one that's been successful. It's like people are pushing this product, but I don't know whether
I actually, you know what? I met one investor, and it was really interesting because his whole strategy was to basically he was a bit of a stumbling investor. Like he didn't really have a huge strategy. He just like sees a government scheme and he goes, geez, that's a lot of cash flow. I'll just get one of them. Now he had, I would say, accidentally built a very large portfolio, like 20 properties, 25 properties or something like that. Purely just based on, he goes, I just looked and there was good yield and off we went. But that's the only one. Every other person is just like, it was great for a year and then it went, and then or whatever. It just never quite works out. And
it was great when I bought it, but I tried to sell it and no one wanted to buy it.
Exactly. There was 1 year left on the scheme. No one wanted it. It was like,
valuations are horrible. The banks don't like them. And, they're overpriced and the banks value them low. But anyway, back to what we were talking about.
Yeah.
What's I think is really important though is getting a good finance strategist who is essentially a mortgage broker, but a good term for a proper mortgage broker, because different banks have different serviceability calculators. So you can't just walk into the bank and sort of see what CBA will lend you and then just go with that. And some people, tie themselves up with 3 or 4 loans with CBA. I mean, that's another mistake I made when I first started out. I was cost securitized and had 3 or 4 loans with St. George. Yeah, not a good move. I had to untie all that. And I get a lot of clients coming to me and they've got all really messed up finance kind of stuff to untangle that. But, if you go to the non-bank lenders, they often have higher serviceability calculators. I mean, take Pepper, for example, does lend you more money and to people a little bit outside the box than some of the big 4. But you need to use both. So once you've been maxed out with one of the big 4, you need to look at some of these other lenders as well. And, a good mortgage broker who's got access to 30 or 40 different lenders on their panel should be able to keep that, keep that dream alive for you.
Totally. So, yeah, and this is the way I think about it too. You sort of want to start on the first tier lenders, your big four, and you want to go max out there, and then you go down to the second tier lenders and go, okay, who wants to give me some debt now? Take that on, and then go down to the third tier lenders, and that's what's going to keep you moving. You've got to have a robust finance strategy around it too, because I have so many people who. What frustrates me, I would just want to kind of say, is that not all mortgage brokers are created equal, right? Not all of them think strategically. Yep. Most of them just think, look, is this going to be with the big four or not? And oftentimes I'll actually have clients who have their own mortgage brokers, and their mortgage brokers actually aren't aligned with the strategy of where they're trying to get to. And so, for example, we'll say, yeah, hey, here's what we're going to go do: cash flow, growth, all of the good stuff, and they'll. On a personal level, that mortgage broker won't necessarily, they'll have a bias towards, say, negatively geared properties or big four lenders or whatever. And they can kind of, I think, completely destroy people's desire to get to where they want to go, because they're not prepared to think laterally. They're not prepared to think strategically. They're not prepared to look for alternative options. And it's much easier for them to say, no, that won't work, and draw a line under it.
So, yeah, absolutely. And so, and I completely agree, and that's what happens with a lot of my clients as well. When I, take on new clients, I basically sit down with them, with their mortgage broker, or maybe a mortgage broker that I've referred to them, and we generally have a meeting, or it might be a Zoom call if we're all in different locations, and we nut out that strategy and work out what they're trying to achieve. And this also comes down to the types of structures you can buy the properties in. Now, obviously, you can buy properties in trusts and company structures and individual names for different types of reasons that your account, you have a discussion with the accountant, they'll, help you with that kind of stuff. But there's also good reason to be buying in those different structures for lending, because the lending changes as well. So you might be maxed out with your own personal names, but you might be able to get, lending through a different entity and things like that. So they're things to consider. And then when you're building your portfolio, look at what the purpose of the property is. Is it a duplex that you are building to hold in your portfolio, or is this something you're actually going to sell and take the profits to invest somewhere else? That might have
to deleverage and to deleverage and decrease your debt. Yeah.
And that might have a different entity to buying something in your individual name, or buying your primary residence and things like that. And then there's also the strategy with obviously I do a lot of stuff in duplexes, because they can be quite flexible, because you can keep one and sell one of the units. And that pays down some debt while still keeping one of those units in a good growth area. So that can help you keep moving forward as well, because everyone does have that ceiling, as they keep getting their debt. So there needs to be ways to manage that, to be able to keep moving forward.
Yeah, I couldn't agree more. Like, there's only really two levers that you need to focus on. It's your debt levels and your income levels. And at a certain point, sometimes it's going to make more sense to increase your yield or increase your cash flow, and other times it's going to make more sense to decrease your debt, i.e., decrease your leverage and give you some of that capacity back. I think that's where the really interesting part of it comes into play. And then thinking about where does that, it's all well and good to have an idea around what type of property you want to buy, but is that strategically going to serve the needs of your portfolio at that point in time? And is that what's going to keep moving forward? Because for example, because everyone does have a ceiling at a certain point, right? But if you can think 2 and 3 steps ahead and go, okay, well, if this purchase does this, and the next one would be something like that, then the third one we might need to, for example, build a duplex, or do a battle axe subdivision and sell the land down to pay down the front. All of that, any of these kind of combinations of things where you can manufacture equity and use that to deleverage, which is going to allow you then to transfer that capital and increase your debt amount and move into another property.
Yeah, so that's exactly right. And what I basically do is I have a roadmap that I work with people, and it basically, you can have up to 10 properties on that roadmap. And, I hesitate trying to plan people's 10 properties in a row, because so many things change, finance changes, property markets change and everything. But we certainly can look at the first 3 or 4 and think, okay, you need to buy this property for cash flow. This one should be in a good growth area. This one's going to do this for you. Like you said, you might do this for subdivision and all that kind of stuff, and sit there with the finance broker and think, okay, we need to get, finance for these properties. And of course, looking at what and a lot of brokers make this mistake, is they just work out someone's borrowing capacity and think, okay, you guys can borrow $1 million, so go buy a property. But if someone comes to me and they've got $1 million borrowing capacity, I sit and work out strategy, and you might have to buy 3 properties for that. you're not going to go spend all your money on one property and then you'll be maxed out. You'll be stuck. You can't do anything because, you might buy a property in Sydney and that's great, but then you're done.
Yeah.
Not that $1 million get in Sydney either.
Totally. There's the other piece in that as well, that let's say you've got $1 million borrowing capacity. Yeah, you could go and buy one property for $1 million, or you could probably buy, let's just say, two properties for $500,000. But in doing so, if you bought the right properties with the right characteristics, with the right yields and all of that kind of stuff, you'll then be able to go and buy a third property, because holistically you will have increased your total borrowing capacity, because you will have essentially bought back some of your borrowing capacity, right?
That's exactly right. And that's always the conversation we have up front. Absolutely.
Yeah. And I find that really fascinating, because obviously you corrode it a little bit over time. You do have some lenders which will take 100% of rent, but if you take, say, I always kind of roughly measure it on an 80% of rent calculation. So if you said, I've got $1 million borrowing capacity, but if I bought the right property in the right place, right time, I'd essentially buy back, 80% of that. So then I'd have another $800,000 that I could spend, and then you could go and buy again, and then you'll corrode 80% of that. So then you'd have whatever we'll call it $600,000 then. But then of course, if you can deleverage as well, that's what's going to keep you moving forward. So it's about understanding how to balance those stepping stones along the way, rather than just picking one type of property and thinking, if I just buy, okay, this one worked well, I'll just go and buy 30 of those, because that just, you'll get, I think you just will hit too many roadblocks. And I think that's why from my view, it's way more important for people to think from a place of principles and strategy than it is to think from a place of tactics. So many people go out there and they go, okay, I know what the secret is. I'm just going to buy under market value. Or I know what the secret is. I'm just going to look for renovation projects. Or I know what the secret is. I'm just going to do duplexes. But it realistically, just like any recipe, if you have a recipe that's made up of one ingredient, it's just the ingredient. But if you have a recipe made up of a variety of different, components and seasoning and all of this kind of stuff, you're going to end up creating a masterpiece. So.
I just want to pick up on that point. That's a really, really good point, because, I've got a lot of people that come to me and they just want to do one thing. They want to do duplexes. They want to rinse and repeat and everything like that, or they want to do, just renovations and whatever. It's all about strategy. It's all about those end goals. So, and like my portfolio is really mixed, and I've even got, apartments in my portfolio. Some people would never buy apartments, but, if they're in the right area and they're, they're getting good cash flow and they're serving a purpose, then that might be okay as well. But it's really about, what you're trying to achieve. So certainly, if you just go out and buy 10 duplexes and they're all in regional centres, that's not really going to achieve your goals either. I mean, I've got some clients that come to me, they've already got 10 or 12 properties, but they're all in regional areas. So they've all paid about 300Ks for these properties. They've got good cash flow so they can keep moving forward, but they've got limited growth. And they've got these goals of retirement. And at the end of the day, it is the capital growth that creates that wealth. Because
totally.
If you've just got cash flow coming in, that's just going to pay off your debt, but you're not going to be able to retire.
You're also going to get stuck and go way slower. So to jump in there, like I like, we focus on positive cash flow, but the way that we do things is like we first identify the right growth location and then seek out how we can get the right yields. Because if you do it the other way around, you're just going to end up buying some random property in some random town just because it's got a good yield number on it. And then ultimately that's not going to get you to where you want to go. Because you're right, like the growth component, that's what's going to fuel further deposits. That's what's going to build up your wealth. That's what's going to allow you to actually keep the thing moving forward. Otherwise, just in the same way that if you kind of negatively gear, kind of works out in the long run, but it's really going to slow that whole process down. So yeah, I couldn't agree more.
Yeah, absolutely. And I work with these clients to sort of, understand their goals and then realize that, you need to get properties in the capital cities. You need to be represented in Melbourne, in Sydney, in Brisbane. You need to get properties in these markets, and we devise strategy on how to get there.
Why do you say that they need to get properties in those markets? Why do you have that opinion? Because
I believe they're the ones that are going to get the most growth. But I'm talking about that if you've got only properties in regional centres that have minimal growth, you're going to be you're going to be maxed out with all these properties that don't have a lot of growth. You might have trouble selling them in the future. They'll have really good cash flow. So I think that you do need to have high growth properties in these capital cities. Now, capital cities is not the only place that have high growth. I mean, you could be buying at Lennox Head, or you could be buying at Wollongong, for example. But I do think that you need to be represented eventually in these capital cities as well, because that's, I think, ultimately going to get you the most growth, and that's what creates the wealth.
Yeah, it's interesting. I mean, I don't disagree. I mean, all you need to do is look at property prices in Australia 100 years ago versus now, and you'll see just a vast discrepancy between some locations and others. An interesting one is that in Melbourne, I can't remember what year it was, but there was it's like 80 years ago or something like that. Pretty much the property prices in every suburb in Melbourne were about the same. Might have been 100 years ago, but then you look at the property prices across Melbourne now, and they're vastly different in different locations. I don't disagree with that on a very macro level, but I think I really think it's possible to get the best of both worlds. Where you're not just going for this one's good, getting good yields, but to actually really get that right positioning in the market to get solid growth. Yeah. And I wonder, like, then if you're suggesting buying Sydney and you're ending up with negatively geared properties, does that then corrode that kind of cash flow goal in the end? Like, if you're getting, let me rephrase it slightly differently. If we take that assumption and we say that, like, Bondi grows more than, I don't know, Bendigo, right, for example, which I think is we could probably suggest. Yeah,
we'll probably agree on that one.
We could probably agree on that one. But let's just say Bendigo grows a lot more than, I'm going to say, Broken Hill, right? So then you've kind of got these three completely disparate locations. Broken Hill might yield at 14%, Bendigo might yield at like 6%, and Bondi might yield at like 2%, right? So if you look at the extremes, and you could say, well, on the one hand, you've got Broken Hill where I can get much higher yield and cash flow, and then you've got Bondi, which get much higher growth. And if you're trying, and I know that this is not what you're suggesting is to go on that level of extreme, but just to illustrate it, but would you not be better off, in your opinion, to shoot for those properties that are going to get, say, if one property gets, say, 2% growth and one gets 10% growth and one gets 5% or 6% growth and 6% yield, holistically, are you not better off having more of those 6% growth, 6% yielding properties on a middle ground?
No, I agree with that. But I'm not saying that you should transition to buy all your properties in Sydney or anything like that. But I think you should have a balance. Like I've got, still got regional properties and things. But see, the properties that I own in Sydney these days are positively geared properties. So it's just part of the strategy to get there. And after a while, with the rents increasing and things, and depending on the cash flow and the equity that you've created from some of your regional properties, and that's why things like duplex is becoming really handy, or subdivisions where you can sell off the land, and I've kind of done that sort of stuff as well, because you're creating equity and you can. You can reinvest that somewhere. Now, if you reinvest that, say that you can buy a property in a capital city market and go at a 70% LVR instead of trying to go in at 90% or something, you've then got much higher yields straight away, and you're representing yourself better. So, and I'm not saying all your properties should be like that, and certainly not straight away. It's just as your portfolio matures, at some point, just get into some of these growth markets, because if you have a look at the sort of growth, and I guess I'm just talking from experience. I mean, the properties that I've got in Sydney have had a lot of growth, compared to the regional properties. The regional properties obviously have the higher yield, but I still think it's important to get that organic capital growth over time as well.
Yeah. I think we're singing from the same hymn sheet. Ultimately, it's about having a good portfolio mix and the right balance, right, and not just doggedly chasing one. I'm a big proponent of taking a non-dogmatic approach. That no two people are the same, no two goals are the same, no two properties are the same, no two markets are the same, and so it's really important to factor in all of those components and go, okay, well, is this the right time for this kind of thing? Is this the right, people talk about adding commercial into the portfolio, which again, I think has a place in most portfolios at a certain point in time in a certain way and for certain reasons. But, again, it's taking a non-dogmatic approach. So I want to ask you now, just before as we start to get towards the end of the episode, I want to ask you, as we record this, we're just in the early stages of 2021. What's your view on the property market, broadly speaking, over the, looking forward rather than looking backwards? Where do you think the property market is going over the next, 1, 3, 5 years, in your view?
Look, I think we're going to see some quite serious growth over the next probably 12 to 18 months. And in probably many markets, I really like what's happening on the east coast of Australia at the moment. I think probably Melbourne will take a bit of a while to catch up, but I do like what's happening on the northern passes of New South Wales and even the Sunshine Coast. And then, there's even Perth, which has been sort of in decline for 5 years, is now really starting to come back and stuff as well. But I think, what I'm sort of seeing at the moment, and this has been talked about a bit, more people sort of working from home offices and not having to go, into work, so on. And people are starting to sort of move out of the cities and have a bit of a tree and a sea change. I see that's going to happen a bit. So I think some of these regional areas and some of these nice coastal locations for lifestyle, and whether that's places like Port Macquarie, Lennox Head, Ballina, Coffs Harbour, you go down the South Coast, for example, as well. I think those populations are going to start growing. Some of those tourist destinations that normally I'd sort of say be very careful of investing tourist destinations are probably going to start getting a bit more of an influx of people wanting to live there, because to some extent people are being able to sort of work from home. So I think the demographics are changing. What will happen is there's going to be less demand for apartments. I think we're going to see rental vacancies in apartments increasing in Sydney. They already are have quite high vacancies in like Brisbane and Melbourne. I think there's going to be more issues with that in Sydney as people now strive for larger properties with a bit of an office space and things like that, and in the outer suburbs. So and may not always be in the North Coast, but we can be looking at moving out to Campbelltown as opposed to living in a west in a small property. So I think the demographics of people are going to change, and it's going to push the growth of some of those suburbs. So the old adage of you have to invest 10 k's from the city to get growth, and I know there's some people out there saying you have to invest within 10 k's of the city in a blue chip suburb to get lots of growth.
That's ridiculous.
I've never agreed with that, because you don't have to. And having said that, I've got properties sort of almost in city in both Sydney and Brisbane, but that's not not the only thing I do. Again, my strategy is quite varied. But you can invest in Campbelltown or Blacktown, and Blacktown's a good example. I wish I'd actually invested there 15 years ago, because I didn't know as much then. I thought, that's a dump, prices are cheap, I'd never buy out there. And if I did, I'd be doing a lot better than what I am now, because there's there's been a lot of growth there. So there's a lot of stuff happening in these outer suburbs, and I think that's going to happen more in the next couple of years.
Yep, couldn't agree more. Awesome. I've really enjoyed this chat. It's been a great way to kind of just bounce some ideas around. Like I love what you guys do and what you stand for and the way you go about doing things. So it's really nice to be able to have that conversation and kind of pressure test some of these ideas and look at things from a fresh perspective. Is there anything you want to share with people? Like, where can people get a copy of your book if they're interested?
So the book's it's available on Amazon. Yep. And it's available on Booktopia and all those kind of online, but it's available in any leading bookshop too. So Dymocks, Collins, all that kind of stuff. It's not actually a plug for my services or anything. It's actually a book that I wrote. It's about my journey, and it's kind of to inspire people that people are sort of in a job and they want to try to better their financial lives. I wrote the book to try to inspire people a bit. So it details my journey. Then we talk about property strategy. I talk about the fundamentals in the markets, and I have a few case studies in there. And there's a little bit of fun. I make fun of myself in the bad property I bought in Blackwater that went from renting for $900 a week to $200 overnight and stuff. So it's a little bit of fun in there. But like I said, it's not a plug for my services. But highly recommend. People reading it. One thing I do mention in there, chapter 11, it's called The Dream Team. That's where I highly recommend people do set themselves with a good team of people. So if you're investing somewhere where you are not familiar with, and a buyer's agent is obviously good, but having a good mortgage broker, a solicitor, an accountant. So talking about the how important all those people are to your team before you even get onto buying the property. So there's a lot of education in there that I sort of try to pass on to people.
Awesome. Great stuff. Check it out if you are interested in learning more about property. It's hard to find good property books out there. So it's good to see this one come out as well. And I know it's been out for a while, but I think it's a worthwhile read. Lloyd, thanks so much for your time. I really appreciated having a chat.
Thanks so much. It's been a hoot.
Awesome. I'll speak to you again soon. Take care.